Is China's economy really as robust as official figures suggest? Or is there a different story lurking beneath the surface? This question has been echoing in the minds of economists and investors worldwide. The Chinese government reports impressive growth numbers, painting a picture of a flourishing economy. However, a closer look reveals some concerning discrepancies. While the growth figures seem to shine, the reality on the ground is somewhat dimmer. The stock market is in a state of decline, with shares of major companies taking significant hits. This is not just a momentary stumble, but a consistent downward trend that's causing unease among investors. Simultaneously, a property crisis is unfolding. Property prices have been falling month after month, with efforts to stimulate the housing market proving futile. This slump is not just affecting the real estate sector, but also posing a significant risk to the entire economy, given the heavy engagement of major Chinese enterprises in this sector. And then there's the issue of high local government debt, which adds another layer of complexity to the economic landscape. The debt burden is casting a long shadow over the country's economic prospects, creating an atmosphere of uncertainty. So, we have a paradox. On one hand, we have an economy that, on paper, seems to be doing well. On the other hand, we have a series of economic challenges that tell a different story. Let's delve deeper into one of these challenges, the real estate crisis. Property prices in China have been on a downhill slope, with house prices falling for 12 consecutive months. This isn't just a matter of homeowners losing on their investments. You see, major Chinese private enterprises are heavily engaged in the real estate sector, meaning this slump in property prices is a risk for the entire economy. It's like a row of dominoes waiting to topple over. One key player in this precarious situation is Evergrande, one of China's largest property developers. Now, Evergrande is facing potential default on its substantial debts. If that happens, it could send shockwaves through China's banking system and property sector like a rock thrown into a pond. This real estate crisis, largely overlooked by overseas investors, could potentially destabilize China's economy. Another issue that's causing concern is the declining stock market and the government's crackdown on businesses. This crackdown has been intense, with the education sector bearing the brunt of new regulations. These rules forbid tutoring companies from turning a profit or raising capital on stock markets, causing major losses for several education firms. Take New Oriental Education and Technology, for instance, which saw its market value plunge by almost 50% in Hong Kong. The ripple effects of these actions are far-reaching, not confined to China alone. Major drops in stock prices were noted in New York-listed education companies like TAL Education and Gaotu. The unease is palpable among investors, their faith in Chinese stocks dwindling. The S&P/BNY Mellon China Select ADR Index, which monitors US-listed Chinese firms, has seen a 7.5% fall in a single week and a 24% drop year-to-date. The government's actions are not limited to the education sector, as companies like Meituan, China's largest food delivery service, have also felt the impact. This series of events is creating an environment of uncertainty and fear among investors, domestic and foreign alike. These actions by the government are not only affecting domestic businesses, but are also having global repercussions. So, with these challenges in mind, what's the way forward for China's economy? As we delve into this, it becomes clear that China needs to implement concrete policies to tackle these multifaceted issues. A significant part of this involves addressing the property crisis. With property prices falling for 12 consecutive months, the government's efforts to stimulate the housing market have been less than fruitful. Managing debt levels is another crucial aspect. Companies like Evergrande illustrate the potential domino effect a single default can have on the broader real estate sector and banking system. China's economy, already grappling with issues like the Delta variant and supply chain disruptions, can ill afford such destabilization. And let's not forget the need to boost domestic consumption. With a declining stock market and the government's recent crackdown on private businesses, consumer confidence is waning. Rebuilding this confidence requires transparency, clear communication, and policies that inspire faith in the future of the economy. Yet, amid these challenges, one thing is certain. China's economy will not thrive in an environment of uncertainty. It needs a clear path forward, a path that is sustainable and inclusive. It remains to be seen whether China will take the necessary steps to build a more sustainable and inclusive economy.